If I say investing and the first thing you think of is this,
Market's at a 5-year low.
then we need to talk. Welcome to our Bankrate Basics investing course. I'm Ashley, and along with Mercredes Barba, we're going to show you the basics you need to get started with investing, from what the stock market actually is to how to decide when to invest or save. Ready? Let's jump in. What if we told you that there was a way to safeguard your wallet against inflation, grow your money by an average of 10% every year, and save up enough money to buy a home and retire? You'd say sign me up, right? These are the key reasons why investing should be an essential part of your personal financial plan. No matter what stage of life you're in, investing helps you build wealth and a more secure future. With that being said, I'm now thrilled to introduce our expert, Mercredes. Let's see what she has to say about why investing should still be a priority, even in today's economic climate.
The main reason to invest is because even though it sounds like one of the scariest parts of managing your finances, it really is the most rewarding. Investing in financial markets is one of the best things that Americans of any age can do to build a more stable financial future. Let's start with some basic definitions. Also known as equities, stocks are securities that give shareholders ownership in a public company. Companies like Apple and Coca-Cola issue stocks so that they can fund their business. When people refer to the stock market, they're referring to several exchanges where stocks are bought and sold, such as the New York Stock Exchange or NASDAQ. Broadly, the stock market is the aggregate of these stocks trading publicly, those that anyone can purchase on an exchange. When news people say the market was up today, they are referring to the performance of the S&P 500 or the Dow Jones Industrial Average. The S&P 500 is made up of around 500 large US companies, while the Dow includes 30 large companies. These indexes track the performance of these stocks and show how they have performed over time.
So, how do people make money from stocks?
There are really two ways to make money on stock. The first is on dividends you'll collect from owning the stock. Your dividend payments may not amount to much, but the rate will often be much higher than whatever APY you get on your savings account. The second and potentially more lucrative way to make money is on appreciation in the price of the shares. For example, if you buy 10 shares of a stock at $100 a share and sell it a year later for $110 a share, you just made $100, in addition to any dividend the company pays out. The more shares of a stock you own, the greater your stake in that company. This can be very profitable over time, as stocks generally provide shareholders with a nice return. For example, the S&P 500 has generated about a 10% annual return over the last several decades. This includes a nice cash dividend too. While stocks can be very lucrative, like all high-reward investments, they can also be risky. Your shares can go down in value or even become worthless if the company runs out of money.
What's the best way to buy stock?
Step 1 is opening your account. Step 2 is to pick your stocks. Figure out what company you want to own, then find out its ticker symbol. This is a 3 or 4-letter code that tells the brokerage what you want. Step 3 is to choose the number of shares you wish to purchase. Some brokers allow you to buy fractional shares in case you want to own a piece of Amazon, but you don't have thousands of dollars to shell out for a full share. And finally, step 4 is to pick your order type. Order types come in 2 big categories: a market order, where you get whatever the going price is, and a limit order, where you name your price but may not get your order filled immediately or at all. Your broker will tell you when your order is filled, and you'll see your shares of stocks appear in your portfolio. And voila, you own stock.
Now, let's dig in to see what causes stocks to go up and down. See you over in lesson 2.